my team in China. I beg your pardon. As always, sorry, beg your pardon. My name is Chris Labuskafny, and I'm the new Business Development Manager for the parts of Pretoria, Mpumalanga, and Limpopo. Now, interestingly enough, people have always asked us, where has the China team started? And it actually happened way back when one of our founders, Mr. Adam Stein, was a lecturer at UCT. And he asked one of his star pupils, what do you want to be one day when you grow up? And with a bit of stars in his eyes, the pupil replied and said, I want to manage a team out of China. I want to be a portfolio manager for a Chinese team that is based for the SA investor. We're quite fortunate today to introduce that young star pupil as Mr. Liang do. Now, Mr. Liang is the CIO and CEO of Prescient China. Liang has joined Prescient in 2005, where he started as an analyst and later went through the ranks in 2012, where, of course, he is now our CEO. He is also joined today by Tian. Now, Tian is the head of product and business development for Prescient China. Tian is also a seasoned investment actuary with a lot of accreditations, making him more than fit for the role. Now, as always, we value your feedback. And for this reason, please feel free to ask any questions that you might have, and we will answer them as soon as we can. Also, please note there's going to be polls throughout the day. So please answer them, as this provides valuable feedback for us to give you the best investment advice and expertise going forward. Now, without ado, I would very much like to introduce Mr. Liang and Mr. Tian. Hi, guys.
Morning, Chris. Morning. Thanks for the introduction. We're going to head straight into today's presentation. So just a quick look at the main topics we'll look in today. I think I'm going to cover RCEP, the world's largest free trade agreement, common prosperity. There's been a lot of media coverage, so there's been some initial details that we can expect on the Chinese common prosperity drive. We're going to cover China big tech. That has been a very hot topic, continues to be a volatile sector for China specifically. And then Liang will take us through a lot of the economic factors and Prescient's performance and positioning as we go through the presentation today. So before I head into details on the RCEP agreement, I just want to recap slightly on our business. So as a business, Prescient China, we still have our two main flagship products, the first two products on the slide, the Prescient China Balance Fund, the US dollar version fund, which is also the Prescient China Balance Feeder Fund available in South Africa to investors with direct investment in rands. So our fund is currently at around 2.9 billion as at the end of 2021. The fund targets a China CPI plus 3% after fees over an investment cycle. Our China equity product, which was launched much later in 2018, also seeing quite a lot of growth during the course of the year of 2021, currently sitting at around 3.6 billion rand. The fund has a benchmark of the CSI 300 Total Return Index and targets a 3% alpha over the long term. An exciting development, which I'll mention briefly for today's presentation, is the launch of our China Gear Protected Fund. It's a US dollar only fund, and it is launching at the end of February this month. But we will likely cover that in our future presentations. As a business, Prescient China currently has total AUM of around $412 million or around 6.5 billion rand. So healthy growth for the year of 2021. As I move on to the team very consistent. We've had the same core team for a long time. Liang, Sean, James, Scott, and myself, all UCT graduates, all South Africans sitting here in Shanghai managing assets. Recently, during Q4 2021, we added a new analyst resource, Arthur Lind, who is a fresh master's graduate from the University of Toronto in Canada. He holds a BCom and master's in financial risk management. And we're very excited to have Arthur join the team to expand our portfolio management capabilities. Onto the Regional Comprehensive Economic Partnership, the RCEP. RCEP, in short, the world's largest free trade agreement. Before I head into detail, I think just to recap quickly on Prescient as a quantitative investment house and the fact that we use factor investment process. So going through a lot of these economic policies and free trade agreement, sometimes quite a lot of political updates really feeds into sort of the policy section of our factor models. And Liang later will go through quite a lot of the economic and valuation factor models. So just to recap a bit on our process and why we do present on a lot of the information that we present. So RCEP, at a high level, is the world's largest free trade agreement. It's actually quite a breakthrough. When I say the world's largest free trade agreement, if you look at it from a map perspective, it actually geographically, landmass-wise, covers quite a small section. But this small section of the world, around 15 participating members, mostly in Asia, also including in Australia and New Zealand, they cover around 30% of global GDP. So it is a massive, massive chunk of the world's economy. And also population-wise, it covers around a third of global population. And it is in an area where there is significant growth in global population, which is why it is the world's largest free trade agreement and probably will continue to be the world's largest FTA, given the expected growth of the region. If we look at some details, RCEP officially took effect in 10 out of the 15 participating countries as at 1 Jan 2022, and the rest of the 5 countries will shortly follow during the course of 2022 to officially implement the free trade agreement. On inception, around 65% of the traded goods in the bloc will immediately reach zero tariffs. So that is very healthy development for trade. Overall, over 20 years, around 90% of traded goods is expected to reach zero tariffs, but that is a long-term target. 65% either way is an amazing start for free trade and for globalization in an environment where we are hearing global decoupling and other sort of complete opposite directional noises. What's also special about RCEP is that it is quite a flexible free trade agreement. You don't have to have 100% of your goods produced in the member state or sourced within the bloc to qualify. So only 40% of inputs of any product that you produce has to be from within the bloc, allowing a lot of flexibility to promote global trade. So free trade within the bloc and also pushing global demand for where resources can come from outside of the bloc. China actually began gathering support for RCEP back in 2012, so we can see it has taken quite a lengthy effort. The trade agreement actually only really gained momentum back in 2017 when the US abandoned the Trans-Pacific Partnership, a competing free trade agreement designed to counter China's influence in the region, but it was abandoned under the Trump administration on fear that it would cost a lot of American jobs. So the result is job security for Americans, but also quite a lot of positives for China and members of the new RCEP trade agreement. Another graphic we all feel often what we see in the media is a lot of coverage of China and the US, and it almost gives the false sense that the US is China's largest trading partner. But if we look at the graphic on this chart, we can see that the US is actually a much smaller portion of China's trade compared to Asian region in general. If we look at just the RCEP member states, which is only a portion of Asia, it accounted for around 30% of China's total foreign trade last year. If we look at also going forward, the RCEP member states, which include Australia and New Zealand, it is expected to grow to around 50% or more of global GDP. So we can see why we feel this is so positive for China. So some key points of why we feel RCEP is very positive for China going forward. It's going to boost economic recovery post-COVID-19. So China obviously had a sharp increase in economic activity post-COVID-19, but it is starting to experience a slowdown. So the implementation of RCEP at early 2022 is going to help another post-COVID economic recovery. We feel it'll be very key to facilitate stable trade and foreign investment in China in 2022, especially given the current political environment. If we consider the US trade and tech wars with China, so quite a lot of sanctions on Chinese companies. This free trade agreement itself will promote trade amongst the member states, various sectors such as textiles and home appliance sectors in China are expected to benefit hugely, and cross-border e-commerce has a lot of tariff barriers being removed. So we expect that sector to grow as well. And finally, we feel RCEP is just the start. Being part of RCEP, the world's largest free trade agreement, will be positive for China, as well as other member states of this agreement in negotiating future global free trade agreements. So that will, again, help push sort of global trade and global economic growth as a whole. So we feel overall, this is positive for Chinese economy, positive for regional economy, and also a positive in the medium to long term for the Chinese financial markets. Moving on to common prosperity, I think common prosperity has been misinterpreted in a lot of conventional media. We've heard sort of noises of China returning to communism, taking money away from the rich to give to the poor, sort of the 1950s red communism. What we want to say today in this presentation is that when we look at the details, so both in terms of what the government wants to implement and sort of the goals that they want to achieve, we do not see anything close to a return to 1950s style communism. What really the government is trying to do is to address inequality before the problem gets worse. Inequality is a problem faced by many countries, whether it's in the developed market or in the emerging market sector. China has around 340 million people in its middle class. That sounds like a massive number. I mean, it's more than 5 times South Africa's entire population, but still 600 million people earn less than $1,500 a year. But still very, very poor for a large chunk of the Chinese population. So the common prosperity drive is more aimed at moving more people into the middle class, making China sort of the most vulnerable of the Chinese population, more and more into the middle class, more and more living a life without too much financial suffering. And that alone, with the consumption driving global economy and China's economy, will be positive for the world as a whole, we believe, in the long term. So how the Chinese government plans to approach common prosperity, we feel some key examples we want to mention. So the government has implemented sort of a 3-pronged approach. Firstly is tax policy, closing tax loopholes, stricter enforcement on tax compliance. So recently a very high profile case is China's online live streamer Queen Via was fined a record 1.3 billion Chinese yuan, the equivalent of $210 million or around 3.2 billion rand. So that's just in taxes. We can imagine the single lady, obviously with a team behind her, how much she has been able to sell via live streaming in China and how much profit she's been able to amass. Rich people in China often can hire the best tax consultants and tax lawyers, and they fully take advantage of gray areas in tax policy. China, the government has come out now to say that the rich cannot flip around and hide behind sort of lawyers and tax consultants and not pay their dues. This highly publicized case is effectively a warning to the rest of the industry that you can make your money, but you really need to pay your fair share of taxes so that the government can use the funds to uplift the poor. So that's the first step in this 3-pronged approach. The second is regulation to ensure responsible business practice. And we all know major tech giants such as Alibaba, Meituan, Tencent. What we don't know is that they have armies of, for example, delivery workers working for them, not earning minimum wage, not having the minimum state mandated medical and pension benefits. And the government last year has come out to clamp down on such practices to ensure that the delivery, so for example, your takeaway delivery drivers are getting paid at least minimum wage, getting the basic medical and pension benefits that the law requires. So obviously it affects the profitability of these companies, but overall, given that it protects the most vulnerable of the society, we feel it is very positive for the healthier development of the industry and society as a whole. So all of these sort of policy implementations, along with anti-monopoly measures to ensure that companies cannot charge whatever they like for goods without competition, we feel is, again, healthy for the industry going forward, and nothing irresponsible, not irresponsible policy implementation. Lastly, the three-pronged approach is the giving factor. So that is more of an encouragement rather than something that's forced on the rich. So the government has encouraged the wealthy to give. So the government has sort of uplifted the tech sector, not really regulated them to allow them to grow, and it's created a lot of tech billionaires, as an example, in China. So the government now wants to create upliftment projects to help the needy, create social responsibility awareness. And the China's rich has really come out and heeded the call. So, for example, Anta Sports, which owns popular international brands like Wilson and Salomon, has the owner, Ding Shizhong, has donated around $1.2 billion so far to charity to help with the common prosperity drive. Richard Liu, founder of JD.com, has donated around $2.2 billion to charity, also on same sort of participating in the common prosperity drive. These are just two examples of many billionaires and companies committing to donate and to be part of the common prosperity drive. So all in all, we feel it's quite positive, and nothing that's forced on the industry. The government will at least appears to be allowing healthy competition rather than monopolized industries. And we feel overall industry going forward will see some healthy development, even though there have been some short-term sort of worries that has come out from all of the regulation that's been introduced last year. Okay, so that's on common prosperity. Moving to China Big Tech. Firstly, I think a topic that we mentioned quite a few times previously is that the MSCI China Index is not really what we feel a real representation of China. What we have called it in this presentation is potentially MSCI China being the China Tech Index. The reason why we say that is that 7 out of the top 10 in MSCI China Index are technology-related companies. So on top of that, if we look at the concentration, the top 10 of the MSCI China Index makes up around 40% of the index. So you buy 10 stocks making up 40% of your China portfolio. We feel that's quite a lot of concentration and not really a real representation of the Chinese economy as a whole, which is why Prescient as a business has chosen the sort of real and more diversified China index in the CSI 300. The CSI 300 we feel is a much more representative index of China. We see multiple sectors in the top 10, and the top 10 only making up just under 24% of the entire index. So much more diversified, less concentrated index, and we feel much more representative of the Chinese economy. So many investors aren't aware of the differences, and they feel many China indices don't have too much of a difference, but in reality, there's actually quite a big difference between these two China indices. And we just like to emphasize that point again today before we move on to the next slide. So if we look at past performance, so these charts are obviously only backward looking, and there's no reason to guarantee that either index will outperform the other going forward. But at least since January 2019, the CSI 300 index has outperformed the MSCI China index by quite a wide margin. So over the period 1 Jan 2019 to the end of Jan 2022, which is a couple of weeks ago, the CSI 300 index outperformed cumulatively by 53%. And in 2021 calendar year alone, the CSI 300 outperformed by 21%. So we can see not only do the top 10 holdings differ quite a lot, the performance profile is also very, very different if we look at the two indices. Going on to selective counters in the Chinese tech sector, if we look at the tech companies here, Alibaba, New Oriental Education, Meituan, and Ping An Health and Tech, some of the representative companies in the sector, along with a couple of China tech indices, tech concentrated indices, we can see that they all peaked back in February 2021 and continues to draw down and drop throughout 2021 and in January 2022. If we look at valuations on the charts on the right, we can see that HSCI, which is the Hang Seng China Enterprises Index, very, very technology concentrated, has dropped in terms of valuation from a 10.2 PE to an 8.9 PE. But if we look at that, looks very, very cheap. But if we look at individual counters such as Alibaba and New Oriental Education, the individual counters haven't gone to levels that are much cheaper than the index. Alibaba is still sitting on an 18.6 PE ratio. New Oriental Education, much, much lower, but because new regulatory changes have impacted the majority of their businesses. So it is very difficult to work out future expected earnings. So the 6.8 PE ratio is still considered fairly high and not exactly in cheap territory. So this is an overview of the China tech sector. Liang will take us through sort of the economic factors and valuation factors and see how we position at Prescient.
Thanks, Tian. So kicking off, I think overarching, the first point that we want to see is GDP growth. So you can see what happened during COVID, where you had this massive crash in GDP in China as we initially experienced the lockdowns, and that was followed by a very, very fast recovery. And the latest data is that for the calendar year 2021, China has grown 8.1%. But what I do want to point out to people is that China's growth rate had been slowing since 2012. So fundamentally, if you look at things on the ground in China, I think a more realistic expectation, once you smooth out all this COVID silliness, is that China's growth rates are going to fall towards the 5.5% to 5% region and even further slow down in the coming years. And for us, that's a healthy development. I think China has changed the model of how it grows. It has population, the working population has already peaked, that's slowly coming down, the growth is becoming higher quality. People are more focused on the environment. So it's not growth at all costs and growth on silly things, but rather more sustainable growth, which is very, very important in China. So as we get towards 2022, as I mentioned, do not be surprised if growth rates are 5.5 or lower. In all likelihood, that is a number that's going to be China's growth rate, but a country of China's size growing at 5.5% is still incredible performance, given the large size of the country. Taking it to the next step, I think if you read a lot of headlines, you'd think that COVID has proven to everyone that globalization is over and trade is terrible, et cetera, et cetera, et cetera. The reality on the ground is a complete opposite. One of the strongest contributors to China's growth last year is actually Chinese exports. So one of the things that's quite amazing to see when you look at Chinese export statistics, so the red lines are actual raw data you'll see, and the blue lines are rolling 12-month data. And every year China has a Chinese New Year, which starts production. So that's why you have these massive spikes down. And very, very quick from now, within a month or two, you may see that spike down. So once again, don't be surprised, it's just Chinese New Year's. But the point I want to make there is just that in spite of COVID, one of the fastest countries to recover actually China, and really shows the resilience of the Chinese supply chain and the fact the strong performance of China being able to actually get production back up and have record exports. And further on, as Tian mentioned, over the longer term from a growth perspective, the free trade agreement reached in Asia was massive. It's for over 1 billion in population, or over 2 billion in population when you include China, with many, many countries with lots of population, which are all consumers both ways. From Chinese people will be consuming their goods and vice versa for the Chinese export machine. All right, going on to the Prescient economic model, actually, in terms of economics activity, our own model has picked up a slowdown in China since about June, July last year. So since about July last year, the Chinese economy has actually slowed down, which you've seen in the GDP numbers a bit later. So it's come off a lot. And one of the things we were quite worried about is inflation. So that's this red line in inflation. And what's really, really good to see is that inflation has started coming off. So by all indications, when they look at PPI, CPI, a lot of other indications, is that more or less inflation in China is still somewhat under control. And a big reason behind that, of course, our interest rate policy as well. So taking a step back, if you look at the top economic factors in our model, what you can see is that, as we mentioned, around June, July last year, early last year, we've seen a very noticeable slowdown. Everything from passenger sales to crude steel to railway traffic, everything slowed down. But we actually started to see a rebound toward the end of last year. And if you look at manufacturing, non-manufacturing PMI, manufacturing is close to the 50 level, but services are still very, very, very healthy. If you look at inflation, CPI and PPI, what's really good to see that Chinese inflation actually in 2020 has been low. We had an upward inflation trend until very, very recently, and that seems to have turned around. At the same time, we've seen that the PPI in China also turning around. Both of those things means that inflationary pressures, hopefully in China, is going to come down over the next couple of months and the next year. And what that allowed China to do in the face of a slowing economy is to cut rates. So you've seen that the loan prime rate was cut for the first time in January. So very, very recent, couple of weeks ago, China has embarked on a rate cutting cycle. And I think what you can very, very clearly see in terms of the policy making is, as you can see, American CPI currently close to 8%. It's the highest inflationary pressure we've seen in America over the last 20 years. One of the easiest interpretation is, yes, there are supply chain issues, but when you print a hell of a lot of money in COVID, eventually, you have full employment, you can't get more supply out. So what happens? Inflation goes up. Vice versa, China during the COVID era has been very, very restrained. China did not massively stimulate its economy. And as a result, inflation has been reasonably constrained within China. And what's ending up happening is, of course, a massive divergence in interest rates. So you've seen that since COVID, the US has, the red line, the US 2-year rate, and the blue line is the China 2-year interest rate. And you can see that since COVID, the US essentially kept interest rate at pretty much zero. And recently, with higher and higher inflation, you can see how quickly that 2-year rate is spiking up. So once again, the 2-year rate is already at 1.5 and spiking up really, really quickly. And vice versa, as China came out of COVID with the global growth, with the boost, China actually had quite an upward-looking interest rate cycle. So they weren't loosening to a strong economy, they were actually tightening. And you can see that since about October last year, as we mentioned, we picked up the slowdown around June last year. But since around October last year, China's rate has steadily started coming down. And with the inflationary pressure disappearing, you can see that the interest rates really starting to come down in China. If you extend that logic globally of what lower interest rate has done for the risk market, you end up a situation with Chinese equity market being reasonably valued and interest rates coming down. So typically, this is a good environment for the Chinese equity market. Right, looking at our fund positioning, to kick off in a quick reminder of how we do this, as we mentioned, to get high real return over the cycle, we believe you need to do two things right. On the one side, you have to get alpha in the assets you buy in, and one of the biggest assets we buy in is equities. And through a quantitative process where we identify long-term factors with economic reason to outperform and doing a hell of a lot of risk control, what we give our clients on the equity side is basically index plus alpha. So that's the first step of getting towards high real return. The second part is, of course, doing our asset allocation. And there we look at valuation of the index, we look at policy of government, and at the same time, sentiment also always play a big role. Often the strongest rallies are not, it's not enough just to have cheap valuation and good policy, that investor sentiment might also be positive towards China. So taking that and recapping on that, I think in terms of the equity side, we've done very, very well. Over the past year, in spite of very weak Jan to Jan, the equity market is down 12%. Our equity carve-out is only down 8.5% more or less. So we had almost 4.5% of alpha. And since the inception of our equity fund, we've done over around 2% of alpha with a tracking error of only 1.9%, so information ratio of 1. So in terms of our equities, we do exactly what we say we're going to do, is that give you guys an index, but get alpha on top. And as a result, is that since inception, we're looking at a 3-year being the top 15% globally in over 1,200 equity funds at a very, very low fee to our equity product. Taking a step further, if you look at the balance fund, what are we looking at? So you can see that from around July last year, our equity allocation to the Chinese market is low by historical standard. We're sitting at around 45 to 50%. But what we're also very, very aware of, as we mentioned July last year, valuation is okay, but policy wasn't great. We've seen a clear slowdown in the economy. At the same time, we had inflationary pressures. At the same time, sentiment was low. So asset allocation was reasonably low. But you can see that we know for very, very clearly that the next phase we're going to is that it's starting to get more and more attractive to be exposed to Chinese equities. So you can see in December, as we've seen a pickup in sentiment in China and the pickup in inflationary pressure easing and easing monetary policy, we increased our asset allocation very, very quickly to almost 70%. Now we reverse that as soon as the global economic sentiment change, or sentiment toward China change. And we're back at 50%. And at the same time, it's exactly what we're looking for. So us sitting on the ground allow us to make these choices very, very quickly as new data is released. And for us, I think it's quite clear. On the one hand, it's quite attractive. You have cutting interest rates, you have reasonable valuations. It's quite attractive to be exposed to China. On the other hand, we have to be careful that there is a big global sentiment part. And on the other side, also, you have the US market, which is looking very, very shaky in the face of an upward hiking cycle from the Fed. Right, taking a step further, Tian mentioned around big tech, and we've been looking at big tech for a while. As mentioned, in our benchmark, we don't have a lot of these tech stocks. And what we've done in early January is put on the first tranche of taking some exposure to these big tech. So what we do, we looked at long term. It's been a very big correction since February 2021. All these big China tech companies are typically down around 50 to 60%. In spite of that, we can only say that valuations are reasonable. As mentioned, we started with Alibaba at a P of 38, at a P of 18. Tencent to this day is at a P of 33. Companies like Meituan, all of that is very, very difficult to value, right? Just like you have Uber in the rest of the world, there's a lot of company-specific risk. And given the Common Prosperity Campaign, given that Chinese government has made clear that even for companies such as these tech companies, they do have to pay social security, they do have to pay pension benefits. They cannot treat people as just contractors, which is getting around all these labor protection in the rest of the world. Some of these business model is not as attractive as it previously looked. So on top of that, you have the risk on the one side, and on the other side, you have that they're corrected 50, 60%, valuation are reasonable. They are fantastic companies. This is not going to change. Living in China makes that even more clear. For those people who are worried about they'll be broken up or they'll be completely destroyed, I think that's a silly notion. That's not going to happen. But what it does mean is that they need more reasonable valuations. And as such, as a quantitative manager, we're very familiar with derivatives. So we took advantage of this and basically started to putting on structures that I'm showing on the right. What it gives us is a lot of upside. So if the market goes up 20%, the index goes up 20%, we'll close to get 16%. If the market crashes another 20%, we'll only lose 4%. And that is if we do it on the entire fund, 100% nominal. Currently, we're only doing around 20% nominal. And as this changes, we're going to make more changes. So should this thing start playing out and should these big tech come to correct further, we're going to add more and more and even more attractive structures. But the crucial thing to us right now is we're getting exposure, but at the same time, controlling that downside. It is almost impossible to time the bottom of the market. And what we're doing now is just controlling the downside while maintaining the upside. Right. So if you look at our funds, over the past year, as we mentioned, the Chinese equity market had a very, very tough time, as shown before. The equity market's down almost 12% on a one-year basis, and the fund is down by 1.6%. So we're not getting to our inflation plus 3 target. But over the long term, we're very, very comfortable getting to the inflation plus target. And on top of that, what we have seen is that the market's getting more attractive. So for us, that's really, really nice. It means going forward, the real returns are likely to be much better than it previously was. If you look at longer term, that's exactly what you see. So you see China Balanced Feeder Fund out of 576 funds since inception, with number 8 over 3 years and 5 years, when the top 3 percentile and the top 8 percentile of total returns. And we really do believe that over the long term of the cycle, it is truly one of the best places to generate real return. Right, on the offshore side, the story is exactly the same. So the only difference from here and the feeder fund is the impact of the rand. What's even more clear in the long term is you can see our outperformance in alpha added versus just ETFs, and how over the long term we're generating close to inflation plus 11 and 12 over the cycle. And that is exactly the same overseas in other 4,400 asset allocation funds, which is the top 2% and top 3% over 3 years and 5 years. Right, so to summarize, and before I open up to questions, I think at China right now can really be summed up as having the opportunity, but also having some risks. So you know that historic data is strong, but it's more uncertain going forward. You can clearly see economies going into a slowdown. As what's really, really nice is that given China did not shoot all their bullets during COVID, it's that it has policy tools and it's trying to enter an easing cycle, the opposite to the US. Valuation is currently a lot more reasonable, which makes it easier for us to get assets that would deliver high real return over the long term. Big tech has corrected materially, but valuations are still high. So before this, it was very difficult, right? These are great companies, but they're so expensive. Well, now they're still great companies and they're much more reasonable. So it becomes easier and easier to allocate to them. With the entire team on the ground, what we're waiting for is, of course, further improvement on the economic side, as well as looking at the monetary policy and also sentiment, as a sentiment towards trying to get more positive. You want to get in there really, really quickly. And us being on the ground allows us to do that. The last thing you want to do is stay out, and then there's a 30% rally, and then you get in, then the real return of the cycle becomes much lower. From standing where we are right now and looking forward, we still believe that high real return can be reasonably expected in a market in China. It's not going to be easy. We are getting Fed hike. It'll be the first time we're going through a tightening cycle in a very, very long time. A lot of leverage has been created globally. A lot of assets are very, very speculative. But we can say that, in a world that's quite speculative and crazy, China seems somewhat reasonable. So I'll open that for questions and going to stop there. Thank you very much.
Thank you, gentlemen, so much. As always, it was very informative. First of all, I would just like to invite all the ladies and gentlemen to ask your questions to the BDMs. As there is a lot of questions, we definitely won't have time to answer it all. But Tian and Liang, I would definitely like to touch on a few. And I think, as always, for us as a Western capitalization, it's always a bit interesting to understand China. So my first question is, and it's actually from Megan, is what is the biggest threat to common prosperity and its succeeding as the government intends?
Very, very good question. I think one thing you can see very, very clearly between America, the difference between America and China, is that in America, there's almost no trust. We have record inequality, but all the power, all the lobbying, everything has been controlled by the businesses. So not much has been done. I mean, to us, it's almost absolutely insane that there's 900,000 people dead of COVID in the USA. And Facebook is not even asked to pay back the fake news they've spread, right? So as the whole anti-vax movement, this entire crazy, where they've earned so much revenue on doing this, they haven't even been asked just to pay that back, not to mention fines, not to mention controls, not to mention changes in policy. So I think common prosperity would have been impossible 8 years ago. And that's because, let's say, if we roll back 8 years ago, you had a Chinese CCP government, which was weaker than what it is now, which is losing its way, which had a lot of business and government interlinked together, which makes it very, very difficult. And I think here now, there's always good sides and bad sides to having a strong government, and President Xi has been a very strong president. And what's strong about it is that it's been able to tell businesses that you have to find that balance, right? So you can't just have it your way. You have to innovate, but after you've innovated and after you've made the money, we then have to spread the money. We have to spread the wealth and make that work. So the biggest danger of that is that obviously this is not popular, right? This is not popular. So on the background, you would suspect that there'll be a lot of people who will be unhappy and they will be funding initiatives doing other things. But like I mentioned, the only place in the world that has any chance of it going through it is someplace like China, simply because you have a government who is not beholden to business completely. It's a bit of a give and take. They know that they need each other. On the one hand, businesses need a stable China, a wealthy China. And on the other hand, Chinese government understand that the objective is not to go back to the 1950s of shared poverty. The objective is to have, we're going to have these big businesses, we're going to have innovation, but make sure that there's multiple stakeholders and everyone benefits. So that's where it's coming from. It's going to be very tough. I mean, rolling back inequality is very, very, very difficult. But I think even like a country like South Africa, I think we can feel it, right? I mean, if you have 30% unemployment, it's very difficult to have a country go. So at some point, the wealth needs to be more equal.
Yeah, I think that's a great answer. The second one, and this is one that's obviously coming up through the news nowadays with the whole Russia invading Ukraine problem, is where do you see China's stance on this, obviously with alliances being formed? And do you feel that a disruption in Chinese equity markets is perhaps more anticipatable than, let's say, a US market, a developed market?
I think not. I think it's a very, very good question. So I know China's historical stance is very clear. We don't get involved. So that's always been China's historical stance. We don't get involved in other people's business. We don't understand it. China would not know the difference, the Ukraine and Russia's deep history, et cetera, et cetera. I think what China do sympathize with, from a Russian sense, is that since, let's say, the collapse of the Soviet Union, NATO has been expanding continuously. And if you look at the map, it's very, very clear it's encroaching towards the Russian border, right? So you get a situation where they feel threatened. And I think from that perspective, trying to sympathize with Russia is that it feels like we're developing and all of a sudden the US is creating all these things, these trade wars, these sanctions, these things to come and do things to you. So what do you do? So I think that's the only thing. But in terms of actual economics, I think China will always support Russia on this in the UN, etc. But China's not going to get involved. It never has get involved. They're certainly not going to see itself get involved between Russia and Ukraine in Europe. That's just not going to happen. So I think from that perspective, the European equity market and the US equity market will be far more effective than, let's say, the Chinese equity market, right? I think if it does happen, which is highly unlikely, once again, it just doesn't make sense for Russia to actually do this, because it sounds more like a very good bluff. It just sounds like Putin's a very, very good bluffer, simply because the Russian economy is not that strong. So the invasion of Ukraine now, there's no upside, they can't hold it down. EU will cut gas imports off from Russia. The only benefit from China, I guess, is that we'll get cheap gas from Russia. That would be the only benefit from China, but China's not going to get involved in Ukraine in Europe.
Yeah, thank you. There's a lot of questions coming in, so we'll definitely answer to specific people. But the last one that I'm going to touch on quickly is, of course, the property bubble, or what we believe was a bubble here in South Africa, looking inwards towards China. What is, first of all, the exposure that you're taking into the property market? And then second of all, your general thoughts on the property market, taking into consideration, we've heard of Evergrande and obviously what we believed would have happened.
Fantastic question. So firstly, to kick off with, the entire equity index had less than 1.5% in the property sector. So once again, the market was way ahead of everyone else in that, in the sense that although the Chinese property is a big sector, their stocks had very, very small market capitalization, simply because this risk has been identified over 3 years ago. So literally over 3 years ago, this risk had been identified in China and people have been taken care of. So in the balance fund, we had something like 0.6% in properties, completely immaterial number. Having said that, for us, what we have done in the recent months, and it's a position we're still building, so we're very, very slowly building, and we have about 2% of Chinese property bonds in the fund. So they get this, you must take this down right. We don't believe in the equities. I mean, we totally don't believe in the equities. But a lot of these bonds are trading at annualized yields of 70 to 150%. They're trading at 70 cents, 50 cents, 30 cents to the dollar on these bonds. And should this reality actually happen, i.e. the recoveries of these Chinese developers are only 30 cents or 50 cents, then the entire Chinese market would collapse and it would be the end of China, given that the Chinese government and policymakers have so many policy tools in place. That is highly, highly unlikely to happen. So we do think that the bonds are quite attractive. So we want to, the balance fund, slowly get to about 5% of the fund in these China developer bonds, right? Just because we think the equity is always going to be a problem. You have to do rights issues, you have to do this. But what the government's trying to do is to stave off collapse, right? So have a stable property market. And given that, it means that the bond has to keep being paid. So we think the bonds are far more attractive than what the equity is. So our base case scenario for the Chinese property market is that going forward, Chinese properties are going to grow very, very slowly. So I don't think you can believe that Chinese properties are going to grow 10, 15% a year in the foreseeable future. We think Chinese property are going to grow at close to 0% real. So a realistic number for Chinese property is more 2 to 5% growth from that point. And you have to ask yourself, what are the attractive investments in the Chinese property sector with that fundamental? And if you get lucky and property market rallies, you'll make a lot more money anyway. So that's also okay. But for us, that's a crucial thing. And that's why we're slowly building up a bond position in Chinese properties.
Yeah, definitely. Guys, as always, thank you so much for your knowledge. And there's a lot of questions coming through, which is awesome from our side. It's very informative. It's very intelligent questions. We're quite fortunate to have such intelligent investors. So to all the ladies and gentlemen, we'll get to all the questions and we will answer your back. But unfortunately for us, that is all time we have. So Tian and Liang, thank you very much. And to all the ladies and gentlemen, we look forward to seeing you on our next presentation and round of webinars. So to all, thank you very much. And we appreciate your time. And we definitely look forward to hearing from you again in the future. For now, cheers, guys.
Thanks
Thanks
everyone.
everyone.